So last week, since we last talked, we had a Fed meeting. We had a Fed meeting and a Fed announcement. We had the dot plots. We had the Q&A session. Curious, when you look back on what happened last Wednesday, what were kind of your takeaways from the day?
So, obviously the biggest thing was, he came right out and said, Jackson Hole hasn't changed. That is still relevant. But the big change was, and what the markets weren't ready for, and the reason we saw such a big sell-off was the new targeted Fed funds rate by the end of the year, saying we're going to go another 150, not 75 this time, 50 next time, and wait and see. Now they're saying we need to go another 100 after today, or 150, I think it was, after the meeting last week, and their overall target of 4.5, and saying that's not it. That may not be done. And he used the word restrictive over and over and over versus neutral or easing. It was restrictive. We're going to stay restrictive. He used that word, I don't know, 20 times at least.
Yeah, and he didn't say soft landing.
No, he said we're probably going to have a recession. There is going to be more pain. And the biggest thing that he said, again, that the markets are unwinding, and we're going to continue to see a little bit more of that going into next week, is the target, the terminal rate target staying above neutral by 100 basis points. So whatever inflation is, the Fed's fund rate, terminal rate is going to be 100 basis points above that. So if we get inflation back down to 2, Fed funds rate's going to stick at 3. So what he said was, again, what the market's realizing, and some of them still don't believe him, but they're starting to, is he said, we are not going to back up. We're going to keep the Fed funds rate higher than inflation by 100 basis points.
Yeah. I thought and was proven right that the most important release would not be the 75 base point that we got. It was baked in the cake. It was all about what's called the dot plot. That's really what you're referring to. It's all about the dot plot. So first and foremost, they're going higher than expected, right? They're talking about an average of 4.6 with a couple of them calling for 5s. That wasn't the case 2 months ago. Second, they're calling for it to go faster. To your point, they're talking about being at 4.4 by the end of the year. Oh. And most importantly, they're going to be there longer. No rate cuts next year. So higher, faster, longer. Finally, the market is going, okay, he's serious. Yeah, I think that was a big takeaway. What did you think about their call on unemployment in GDP? GDP basically low, but not negative. And unemployment, I think, got as high as 4.7. Do you think those are possible? Or do you think those are just wishful thinking?
I have no idea. Yeah, unemployment, I don't know that we can make a dent in that right now. I mean, the job market is still super strong. So, the only way to, this is the other thing the market's digesting. The only way to get to their unemployment target is to cause a recession. That's the way you're going to do that. A deep recession.
A deep recession.
Yeah, because you need mild recession just to get unemployment in check and eliminate half the jobs that are out there, or most of the jobs that are out there. Then you need even deeper to actually create a deficit in a higher unemployment rate. So what the markets realize is that where the Fed wants to see the labor unemployment rate is going to need a deep recession. And again, that the other thing too is that he said we are not going to sell any MBS right now. So that question was asked, and he said we're not even looking at it. We're not even thinking about it. It's not even on our radar. They've started QT and they're unloading some treasuries and things, but they're not touching MBS.
Yeah. So the other thing that, again, this might be wishful thinking. Sometimes when you try to read the tea leaves, you read them incorrectly. When I take the Jackson Hole meeting with what I saw Powell do Wednesday, and oh, by the way, Powell was talking Friday again as well at a offsite somewhere. And I think Jerome Powell wants to get rid of what's called the Fed put. I think for the last 40 years, the stock market has come to count on the Fed pivoting, the Fed bailing them out. I think Jerome Powell is looking at inflation, looking at how it's hurting the 90% and not the billionaires. And I think Powell, either consciously or unconsciously, saying, I'm going to kill the Fed put, which, if that's true, means the stock market is in for a world of pain. What do you think of that?
Yeah, I mean, that's the message he's sending. The question is, will they do it? Because they haven't yet. And, we've been in a Fed put since really 08, 09. Meaning the Fed's going to be there to backstock the markets, prop it up, just like we saw in 2020.
Well, I think the Fed put started in 01 with Greenspan. I mean, I think that's when it started.
Yeah,
Yeah.
and you saw the results of that. I mean, he
Yeah.
single-handedly killed the market himself, with this whole Fed put thing. But yeah, I mean, that's the message you're saying is they're trying to get the Fed out of the policy of propping up the markets, letting the dust settle
Exactly.
where it may, and letting markets figure out where they need to be and assets reprice accordingly. So that's what he's saying. The question is,
Does he have the
if
backbone?
inflation
Yeah.
can stabilize and things like that, will they let the market work itself out?
Yeah. Again, I don't know if you've ever read Paul Volcker's biography, which I've read. I haven't read the whole thing, but I've read a couple of chapters. Um, he was the most hated man in America when he was doing what he was doing, jacking rates up. Presidents were mad, Congress was mad, Joe and Jane were mad, and everybody was mad. Right, the economy was that second double dip when he went to 20%. Everybody was calling for his head. And Paul Volcker was sitting there smoking his cigarette in Congress, basically telling Congress and giving the middle finger. We are an independent organization. We're going to do what's right long term. Yes, it's painful now, but it's less pain than would be basically if we let this thing get out of control. I think Powell is right now on the cusp of becoming the most hated man. He does another 1.25, 1.5. Everybody's going to be mad. And right now, people in real estate are mad. People in the stock market are mad. 401ks are mad. He goes another one. Like, he's going to raise 75 on November 1st. I think November elections, midterms are like November 8th or something, or 7th or whatever it is. He's going to raise right before midterms, and he's going to hit him hard. He's going to hit a 75. Could be 100 if inflation is still going up. So I think Jerome Powell knows that's what he's signing up for. What do you think?
Yeah, I mean, darned if you do, darned if you don't. I mean, half the crowd hates him, half the crowd's, cheering him. And that's just the way it's always going to be, right? You can't make anybody happy. And some people are going to say he's doing the right thing, some people are going to say he's doing the wrong thing. What you can do is look at who's talking and what's their position. So, obviously market participants, as far as the housing market goes, I mean, I don't see where anybody could be upset if you're locked into a 2.5% mortgage for 30 years.
Yeah, the Fed broke housing, buddy. There was, I think it was Black Knight did a study back when rates were 5. They said 80% of loans, or residential loans, are below 4. If rates are at 7 now, which they ticked over last week, there's got to be 90% of loans below 6. I mean, why would you sell or move? It's just going to be this winter. Why would you ever list? I mean,
that's a whole nother conversation we can do maybe in video 3 if you want on the housing market and stuff.
That is video 3.
But there's two sides of that coin. So there's one groups that bought and they're locked into low rates, which is great. They got nothing to complain about, because at the end of the day, maybe they overpaid a little bit. But when you look at buying at a reasonable level, paying 7% over 30 years, you're going to pay twice as much for that property versus you bought a little higher at 2.5%. You're still in the good. So what it's doing is it should start resetting house prices so that, people can now buy a house, but there are a lot of people saying that they can't afford a house. That's only because the prices are still too high. So once, if this stays high enough, long enough, that'll come back, and it's already starting to a lot of markets, but we can dig into that in another video.
Yeah, we will do that in video number 3, because I think you and I might disagree, and the audience loves when we disagree. So
bring it on. I'm
bring
ready.
it on. There you go. Well, Greg, before we do, where can people find you?
GregDickerson.com. That's where all my info lives. Go check it out.
Thank you, buddy.